Imagine this, it's 2025, and a curious 10-year-old boy walks into a room. He's holding a piggy bank, dreaming of a future where his small savings could one day turn into something extraordinary. That boy? Let's call him Warren Buffett. But not the Warren Buffett you know. This is young Warren, starting fresh in today's fast-paced world, with all the opportunities and distractions it brings. Now imagine you're right there with him. You're both standing at the starting line of your financial journey. The question is, what would he do? And more importantly, what can do if you're starting your journey today, at 30, to achieve the financial freedom you dream of? In this video, we're going to break down 5 key strategies that Warren Buffett would likely use if he were starting his investing journey in 2025, and how you can apply them to your own life. Let's get started. Alright, let's be real, nobody starts out as Warren Buffett. We all have to begin somewhere, and the journey to financial success is often a long and winding road. But the good news is, you don't need to be a financial genius to get started. Even Buffett himself started somewhere. He wasn't born with a golden touch, he learned and mastered the basics over time. The first thing young Warren would do is master the basics. And at the heart of it all is understanding the magic of compound interest. This fundamental concept is the cornerstone of building wealth. Think of it like rolling a snowball down a hill. It starts small, almost insignificant, but as it rolls, it picks up more snow and grows larger. At first it's small, and the growth seems insignificant. You might not even notice the change. But as it rolls, it picks up more snow, growing bigger and bigger at an accelerating rate. This is the essence of compound interest. That's compound interest in action. It's the process of earning interest on both the initial amount of money and the interest that has already been added to it. Now let's bring this concept to life. Imagine you invest $500 a month starting at age 30. With an average annual return of 8%, by the time you retire at 60, you'd have over $750,000. That's a substantial amount of money. And it all started with small, consistent investments. This is the power of letting your money work for you over time. The earlier you start, the more time you have for that snowball to grow. That's the power of letting your money work for you over time. The earlier you start, the more time you have for that snowball to grow. It's not about making huge investments right away. It's about consistency and patience. The earlier you start, the more time you have for that snowball to grow. Even small amounts can turn into significant sums, if given enough time. Buffett himself calls this the snowball effect, and it's one of the most powerful forces in finance. It's a simple yet profound concept that can change your financial future. You don't need to be a genius to be successful with investing. You just need to understand the basics and start early. Start small, stay consistent, and let time do the heavy lifting. It's about making regular contributions and allowing compound interest to work its magic. Remember, even a small snowball can turn into an avalanche with enough time and consistency. So start today and let your financial snowball grow. Now let's talk about where young Warren would put his money in 2025. Imagine a young investor, eager to make his mark in the financial world. He has a piggy bank full of savings and a laptop displaying the latest stock market trends. The choices are overwhelming, but the path to success doesn't have to be complicated. He wouldn't be caught up in the hype of meme stocks or trying to time the market. The allure of quick gains from trendy stocks can be tempting, but it's a risky game that often leads to disappointment. Instead of chasing the latest fads, he would focus on a more reliable strategy. Instead, he'd go with what works: low-cost index funds. These funds are designed to mirror the performance of a specific market index, providing a stable and predictable investment option. By choosing index funds, he can avoid the pitfalls of speculative trading and build a solid financial foundation. Index funds are like the workhorse of the investing world. They may not be flashy, but they get the job done efficiently and effectively. Just like a reliable workhorse, index funds steadily plow through the market's ups and downs, delivering consistent results over time. They're designed to track the performance of a specific market index, like the S&P 500, which represents 500 of the largest companies in the US. This means that when you invest in an index fund, you're essentially betting on the overall success of the market, rather than trying to pick individual winners. The beauty of index funds is their simplicity. There's no need to constantly monitor the market or make frequent trades. You can set it and forget it, knowing that your investment is aligned with the broader market trends. This hands-off approach makes investing accessible to everyone, regardless of their financial expertise. When you invest in an index fund, you're essentially buying a tiny piece of all the companies included in that index. This means you're not putting all your eggs in one basket. Instead, you're spreading your investment across a wide range of companies, industries, and sectors. This provides instant diversification, spreading your risk across hundreds of stocks. Diversification is a key principle of investing because it helps to mitigate risk. If one company or sector underperforms, the impact on your overall portfolio is minimized. And the best part? Index funds historically outperform most actively managed funds over the long term. This is because actively managed funds often struggle to consistently beat the market, and their higher fees can eat into returns. By contrast, index funds aim to match the market's performance, which has proven to be a winning strategy over time. This is because they have lower fees and aren't trying to beat the market, but simply match its performance. Lower fees mean more of your money stays invested, compounding over time and contributing to your overall growth. It's a cost-effective way to build wealth without the stress of active management. Buffett himself has said, when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. This quote underscores the importance of keeping investment costs low and avoiding the traps set by high-fee managers. He's a big advocate for keeping things simple and letting the market do its thing. By following his advice and investing in low-cost index funds, you can take advantage of the market's natural growth and build a secure financial future. So, remember, when it comes to investing, simplicity is often the best strategy. Now here's a rule that Warren Buffett lives by, and it's more important than ever in today's world. Avoid debt like the plague. Debt can be a silent killer of your financial dreams, creeping up on you and slowly draining your resources. Warren Buffett, one of the most successful investors of all time, has always emphasized the importance of staying out of debt. He believes that financial freedom starts with being debt-free. Seriously, it's one of the biggest wealth killers out there. Debt can cause immense stress and anxiety, affecting not just your financial health but also your mental and physical well-being. The burden of debt can make it difficult to focus on your goals and aspirations, as you're constantly worried about making ends meet. Think about it. Every dollar you're paying in interest on credit card debt or loans is a dollar that isn't working for you, growing in your investments, or helping you achieve your financial goals. High-interest debt, like credit card debt, can quickly spiral out of control, making it harder and harder to break free. Instead of letting your money go towards interest payments, imagine the possibilities if you could invest that money and watch it grow over time. Instead of falling into the trap of easy credit and impulse purchases, focus on building a solid financial foundation. This means being mindful of your spending habits and making conscious decisions about where your money goes. By creating a budget and sticking to it, you can ensure that you're living within your means and not relying on credit to get by. This starts with living below your means and saving a portion of every paycheck. It's important to prioritize saving and make it a non-negotiable part of your financial plan. Even small amounts saved consistently can add up over time, providing you with a cushion for unexpected expenses and helping you build wealth. One of the most important things you can do is build an emergency fund. An emergency fund acts as a financial safety net, giving you peace of mind knowing that you have money set aside for unforeseen circumstances. This fund should be easily accessible so you can tap into it whenever you need it without any delays. Aim to have at least 6 months' worth of living expenses saved up in a readily accessible account. This might seem like a daunting goal, but it's achievable with consistent effort and discipline. Start by setting small, manageable savings targets and gradually increase them as you become more comfortable with your saving habits. This will protect you from unexpected events like job loss, medical emergencies, or car repairs, and prevent you from going into debt when life throws you a curveball. Life is unpredictable, and having an emergency fund can make all the difference in how you handle these challenges. Instead of resorting to credit cards or loans, you'll have the financial resources to cover these expenses without adding to your debt. Remember, financial freedom isn't just about making money, it's about having control over your finances and not being beholden to debt. By avoiding debt and building a strong financial foundation, you can achieve true financial independence and enjoy the peace of mind that comes with it. Take control of your financial future today and start building your fortress against debt. Warren Buffett is a voracious reader, and he credits much of his success to his constant pursuit of knowledge. In today's world, information is more accessible than ever, and it's a goldmine for anyone looking to improve their financial literacy. Start by picking up classic investing books like The Intelligent Investor by Benjamin Graham, which Buffett himself credits as a major influence on his investment philosophy. But don't stop there. Explore online resources like Investopedia, Khan Academy, or Coursera, which offer free or affordable courses on a wide range of financial topics. The key is to make learning a lifelong habit. The more you understand about investing, personal finance, and the markets, the better equipped you'll be to make informed decisions with your money. In the age of social media and 24/7 news cycles, it's easy to get caught up in the hype and noise of the financial markets. But remember, Warren Buffett didn't build his fortune by following the crowd or chasing short-term gains. He's known for his long-term perspective and his ability to tune out the noise. He understands that the market will always have its ups and downs, but over the long run it tends to go up. So instead of checking your portfolio every day or panicking when the market dips, focus on your long-term goals. Remember why you started investing in the first place. Avoid get-rich-quick schemes or trying to time the market. Those are strategies for gamblers, not investors. Stay disciplined, stick to your plan, and remember that building wealth is a marathon, not a sprint. Slow and steady wins the race. So, what would Warren Buffett do if he were starting in 2025? He'd keep it simple, stay disciplined, and focus on the long game. And here's the truth: you can do it too. The road to financial freedom isn't about luck or genius. It's about small, consistent steps taken over time. Remember, the snowball effect is real, and even small contributions made consistently can lead to significant wealth over time. Start by mastering the basics, investing in low-cost index funds, avoiding debt, and never stop learning. So why not start today? Your future self will thank you. Start your financial journey now. Subscribe for more insights.